Okay. So welcome. Today, we're going to talk about the financing contingency. So I'm going to be referencing 22A, and I'm going to try to incorporate some of the changes that are happening tomorrow. So the financing contingency, we'll be discussing when we should be using it, how it should be used properly, how to make sure that we're following the rules to protect our client under this contingency. And we're also going to talk about how and when this contingency is waived, what does and does not constitute a waiver of this, and ways to leverage this contingency for a strong offer in a competing situation. So first, I wanted to start with a question. Can a buyer come to the closing table with more than the minimum down payment without a penalty? Yes, of course they can. So I pulled up the new financing form. Sorry, let me get my piece out of the way here. When we fill out the financing contingency, what we're making is a contract promise. We are telling that seller that our client is going to be applying for a specific type of loan. They have a specific amount of time they need to apply for this in. And everything that's marked in paragraph 1 is an obligation that the buyer is promising to do. So for instance, if you mark conventional first, then your buyer does need to make application for a conventional first mortgage. If you're not sure and maybe have the option of doing a couple different types of loans, it is possible, not very advisable, but possible to mark more than one box. They have added the down payment program on the options of these boxes, but whatever boxes are checked are the loan types that the buyer has to make application for within the time frame specified in order to have the protection of the financing contingency. So, scenario, they mark conventional, but at the same time, they think, oh gosh, I don't know if that's going to go through. I'm going to also apply for some other type of loan, a bridge loan. The only financing that they have the protection of the contingency for is the type that they have identified in this paragraph. And they also are going to need to prove that they have made full application within that 5 days. So keep in mind when you're checking out those boxes, these are obligations that the buyer has in order to keep the protections of this. Now, if they don't make application within the 5 days, they do risk waiving the entire financing contingency, appraisal included. So just to kind of keep in the back of your mind, and I know that we've all been in a situation of this, make sure that when they make application, you verify with the lender that they have in fact given all the proper documents to do so in every definition that they consider making application. So why does it matter when you're filling this out? This contingency is a contract to make the application and the down payment noted. It absolutely matters that they can apply for this loan. Not applying for this particular type of loan with the down payment they've promised at minimum will initiate an automatic waiver of this contingency. They're only getting protections for what they're promising to get protections for. The pre-approval letter doesn't always tie them to the lender. So if they come with a pre-approval letter for a specific lender, but yet within those 5 days decide they want to use a different lender, that's completely fine. The only thing they cannot do is they cannot change that lender that they have used in this first 5 days after those first 5 days. And they have to apply for the application that they said they would be applying for. As a seller side, if you have a particular lender that your seller feels very strongly and comfortable with, you can, in the contract, require that buyer to use the lender identified. There's nothing wrong with that. So what happens if they want to change? How do we even do this? How do we change? Well, we need the seller's permission to change, first of all, but in order to change, we need to know what they're changing to.
This is outside of the 5 days and what they've specified, correct?
Yes, outside the 5 days, you do need permission, and the way to get permission is through a form. The 22AC is how we get permission. When you fill out the 22AC, though, you need to know what they're changing to or the lender they're changing to. So you can't just have a blank form filled out that they might change sometime along the way. You actually have to have an identified lender and an identified different type of financing. This is just the second part of that page. So I could blow it up so you could see it all on one page. So if you want to consent to changing the loan type, you need to actually have the loan type that they're changing to. And if the lender itself is being changed, you need to be able to identify who the new lender is going to be. Make sure that you have this signed before they go through the whole process, because you don't want to risk the waiver of this financing contingency if you do need to change. All right, this is my favorite paragraph, because this is where we can leverage the most when we're using the financing contingency. Unless it's waived, it survives closing. So these two boxes are one of the two ways we can take that protection for that buyer away. Box 2A gives the seller kind of the ball in their court to initiate the waiver of the financing. It gives the seller the right to come to the table and say, okay, buyer, you've had 21 days. I'm just going to assume, because it's right here, boilerplate. You've had 21 days to get your financing in order. By this time, you should be comfortable enough with the way the loan is going and confident enough that my seller can actually have the same confidence that we're going to close. So we'd like you to remove the protection of the financing contingency. This seller's notice to perform is an action that needs to be initiated by the seller. It is not automatically done. And in doing so, the buyer does get to choose whether they actually waive it or not. The appraisal, you have the choice of will or will not waiving appraisal. Typically, we see that it won't waive appraisal. So if the time comes and you have the appraisal provision into a, paragraph 3, then you're only waiving the financing contingency, not the appraisal. So that means the approval of the financing with enough down payment, still subject to the lender's approval of the appraised value. Now, the way that we can leverage a financing contingency to be just like cash or to be as solid as possible is to not check box 2A, but 2B, which is an automatic waiver. It just eliminates the conversation and automatically waives this financing without having to give notice and wait for an answer. Does anybody have any questions or situations where they've felt uncomfortable doing something like this? This is one of those things that if we are truly representing our client, we at the very least as sellers, agents, want to make sure we are giving the seller the right to ask the buyer to waive the financing. So it's my own personal opinion that every single transaction should be delivering a 22 AR unless it's waived automatically. If you're negotiating closing costs, box 3 is the proper place to put it. And then if your client has to get out on earnest money, there are specific things that need to take place, which are bullet pointed specifically in paragraph 4. So if they intend to get out on the financing contingency, they have to meet these requirements in order to retain their earnest money. They have to have applied for the application at a timely manner within those 5 days. They have to have had enough money down according to what they said they would have down, and they have to have reasons for being unable to close. This is going to be on the lender. These letters are really important in getting the earnest money back based on this contingency. So if you have a lender that is working with you and you do need to get out on this, make sure that the lender is very well aware of the things that need to be in this letter, and make sure that you're following along the way to know that this buyer has made application on time and has turned in the things they need to. So If by chance they have to get out on this contingency, it's pretty cut and dry. I'm going to spend a little bit longer on the appraisal because it's come up several times where the appraisals have come in low. And I'm not sure if this is a trend that's happening or if it's just a certain area, but we have had appraisals come in low. We had an appraisal come in $20,000 low. And the buyer has 3 days to get that appraisal, the notice of low appraisal to that seller, if they are going to try to negotiate back and forth with what's going to happen. Once you give that notice, the seller has 10 days to decide how they're going to respond to this. And a couple times, people have been able to do a reconsideration of value and have it work. If you were on the seller's side and trying to do a reconsideration of value, take the full 10 days to really hash out how you're going to work with this. Because once you respond again, it's kind of like an inspection response where you've responded. That's your answer. And then in a different form, of course, we have what happens. It's kind of laid out here for the options, but we do have the back and forth of what happens in our appraisal response, which will be next week. They can either, of course, consent to lower the price, they can do a reconsideration, they can propose a new price, or the seller can just reject the whole idea in the first place. Either way, when we do this, sellers, take your time making this decision, and buyers, if you are far enough apart, talk it through to see if giving this notice is going to be in the benefit of your client. I love it. Okay, once the seller has figured out what they're going to do, they do have 10 days to do this. The buyer does have 3 days to respond. And the only exception for having to be forced to do anything with this is when you have an appraiser from the VA, the FHA, or USDA. They're the final say. They have an mandatory clause that, all in a nutshell, says, you know, buyers, you're not going to be required to do this. It's going to be your choice if you want to do this, but we're going to give you an out because the VA thinks, you know, it's appraised for this value here. So you can negotiate with VA loans. The buyer won't be obligated to actually follow through if they choose to walk away from a low appraisal. Part of the important piece of the financing contingency is this inspection paragraph, and they did update this in the new forms coming out tomorrow. But when you have a lender involved, the seller is automatically, by signing this form, allowing that lender to conduct any inspections they feel necessary. That's any inspection they feel necessary. It's not going to be the seller's job to pay for it, but the seller is already giving permission by signing this form to allow that lender to come in or send whoever he feels he needs to get everything for his appraisal. So well, septic, roof, whatever they deem necessary, you're going to give them access to. Okay, so part of the whole idea with this form is to kind of think outside the box. So I have some situational questions, and I just think that they're worth thinking about. I'd love to know what everybody thinks about these right here. So your buyer has a pre-approval letter for a conventional loan. The lender approved them for an FHA when they made application. The financing contingency box was checked for conventional. So what do you do to protect your buyer?
Buyer and the pre-approval.
When the buyer made application, they either accidentally or not accidentally.
22 AC to just ask permission. But you should have done that before you made application and got approved on the.
You should, yes.
So basically, you've waived your financing contingency if you're outside of the 5 days and you didn't give notice or ask permission, correct?
If you don't ask permission to use the financing, then you are technically outside. So yes, you are in a very precarious situation right there. So the moral of this situation is double check your pre-approval letter, double check your financing contingency and make sure they line up. And if they don't, put in either a 22 AC to make sure they do line up, or check the extra box and get that initialed, because they did apply for it within the 5 days. So if you amend the 22A, that's another option too.
Jen, can I ask a
So-
So
question?
wait a minute though. So we get mutual acceptance.
Okay.
And you've accepted my offer on a conventional loan.
Yeah.
That was why they accepted it. You're telling me in those 5 days, if I amend it without permission, I can change the type of financing?
You can only change the lender within the first 5
Yeah,
days. You can't change the loan type. Yeah.
I didn't think so. I thought that's what you said, so I'm glad I clarified.
No. So if they, I mean, anything can be changed
Right.
at any time.
Yeah.
So in this situation, your dates won't have to change for those 5 days.
Right.
Because everything's for mutual acceptance. So if you go back to the 22A and you just initial a second box that says you're doing FHA, all your timelines still match up.
As long as the seller agrees to allow you to
Correct.
switch it.
Yes.
Perfect.
So it's another way to get permission. Rather than necessarily filling out a 22 AC. 22 AC may flag a little bit differently for some people. It may trigger people a little different. Here's another one. There's no financing contingency or evidence of funds stating there is a loan on the home purchase. The buyer wants to use financing, but has removed all the contingencies to make their offer very strong. The appraisal is ordered and the seller decides they don't want to let the appraiser conduct the appraisal. Is the seller right or wrong to deny access? Quiet bunch.
I think it's,
Wait.
I don't think the seller is under any obligation.
Right.
It wasn't disclosed.
Yeah, so the seller is not under any obligation to allow access for anything because it was not stated in there in any place. The 22 EF does have verbiage that also obligates the seller to cooperate. But since that was left out, And-
My question, that was where I go to though, in my head, I was like, well, there's no.
Yes.
22 EF, and I mean, there's no disclosure, so they're under
Right.
no obligation.
right? So in essence, they have waived financing just like everything else, and they've waived
Yeah.
access. It's similar to not having an inspection contingency and then wanting to get in to inspect. They don't have to let you in.
I think Donna got it right too.
Was she doing the chat?
I don't know. I'm just engaging. I don't think she's doing the action.
So moral of the story is we need to know where the money's coming from in all situations. If there's not a financing contingency, there should be a 22 EF. In fact, you should be accounting for every single dollar that goes into the sale in some way or another, even if they're putting down a large down payment. So if they're putting 10% down and the home is $1 million, that's $100,000. Don't you want to know where $100,000 is
Sure.
coming from? Not only that, but closing costs. I've run into a situation where my closing costs for my buyer was going to come from a contingent source of funds that I don't even know how to get personally. So they were going to get Bitcoin gifted to them for their down payment or for their closing costs, not even their down payment. So if there's any lesson to learn from the mistakes that I've made in the past, it's to account for 100% of the purchase price in the contract.
Yeah.
Here's another odd one. The appraisal came in at value, but had conditions. Does the seller have to negotiate the conditions? Does the seller have any other obligations? And does this mean that the home did not appraise by definition?
Is this happening tomorrow or is this in the current?
This is right. Well,
That'll change.
we'll discuss that. We're going to talk about tomorrow.
Okay.
This is tomorrow's form. So I'm going to take this piece by piece because this is tomorrow's form. Starting tomorrow, conditions called out by the appraiser are going to be negotiable. The seller is under zero obligation to do those things, but the buyer has the right to come in and ask for those things to be done. Now, starting tomorrow, if that request is made, it's an all or nothing request. So the seller either has to do all of the things asked for or nothing. Or in some way or another, all the things need to be done. I'm not saying seller has to pay for them all, but they all need to be done or nothing, because the bank is not going to nitpick about the conditions they have listed. They want 100% of their conditions met. So as of tomorrow, they can negotiate this. Now, it technically does mean it has appraised. So up until tomorrow, everything before tomorrow, this meant that that appraisal provision was over and done with. And I'm sorry, sucks to be you, buyer, but if there's conditions, that's not my fault. It's still appraised. You know, you're out of luck. As of tomorrow, it does mean that it did appraise. However, with those conditions, even if a financing contingency is waived, the buyer can walk away with their earnest money if there's no solution on how to take care of those. So keeping that in the back of your mind, there's an out now, even if financing is waived, but appraisal is kept.